Hi, good afternoon, everyone. We are going to get started with our presentation. My name is Elena McCargo. I'm the Vice President of the Housing Finance Policy Center, and I'd like to welcome all of you to our webinar today. I wanted to start with a couple of housekeeping items, and then I'm going to make some introductions and get out of the way for the presentation. First and foremost, I just want to let everyone know that the webinar today is being recorded. The recording and the slides will be available and shared with all of you after we are done today. So in case you missed important details, they'll be available afterwards. Everyone on the line is muted, all participants. So you can type your questions and use our comment feature in the webinar to enter any questions. There's a Q&A box that'll be moderated throughout the duration of the session. Make sure to please include your name and organization when you're typing into the Q&A box so that we can note that. And if you're following us along on Twitter, you can use the hashtag #LiveAtUrban and follow the conversation online there as well. So first and foremost, I just want to welcome you all. Thank you again for being with us. I want to first start with just providing a little bit of a backdrop on what's happening and the sort of genesis of today's presentation. First and foremost, the Housing Finance Policy Center, since over the last 6 years, has been providing timely access to information, data, and analysis on the most prescient issues of our time. And the current moment in the COVID-19 crisis has led us to recreate or reform what was known as our Mortgage Servicing Collaborative into what is now called the Mortgage Market COVID-19 Collaborative. And this event is one of the first that's going to kick off a series of webinars that we're going to be doing specifically related to the mortgage market COVID-19 crisis and its implication for homeowners, its implication on the mortgage servicing industry, and its ripple effects throughout the system. I'd like to acknowledge and just throw support out and thanks to Bank of America, who has been our supporter and enabled us to convene the Mortgage Markets COVID Collaborative, which has been going since the middle of March and has a wide array of participants who have been essentially working together to stay as real-time and close to the issues, the data, and doing new and important analysis to help us get through this crisis in a way that is working for not only the industry, but for consumers as well. I'm going to begin, or we're going to start with some remarks from one of the people who have been with us since day one on this, since this crisis began, which is Michael Bright, who's the CEO of the Structured Finance Association. He's been CEO there since January of 2019. It's been quite a busy time and year, Michael. We'd like to thank you, first of all, for your support and work with us and your advocacy. And we also, your expertise and knowledge in terms of these really critical policy matters that we've been grappling with are really critical. And the members that you work with and serve at Structured Finance Association are key to the solutions to this. So I'm going to start, or we'll kick it off, or let Michael take it over with his opening remarks, and then we will turn it over to Lori Goodman, my co-director here in the Housing Finance Policy Center, who will introduce the panel. Michael, take it away.
Great. Let me get on here. So am I visible and can you hear me? Is all good there, Elena and
yes.
Urban Institute? Wonderful. Well, look, thank you, Elena, and thank you to the Urban Institute for hosting this event. Thank you to everybody who's participating in this conversation. It's a very important conversation. It's obviously a very timely conversation. Urban is an excellent convener on these topics. And so, of course, thank you for allowing me to come and give you a few opening remarks. I'll try and share some information with you in regards to what we're seeing and what we're tracking. And, hopefully it helps inform the dialogue. So, but I definitely look forward to hearing the panelists' views on this, and I look forward to working with you all in the coming months. Elena, certainly, I'm very appreciative of the work that the collaborative has been doing. You guys you rolled up your sleeves on this like right out of the gate, and you're forcing the right conversations on the right issues. And so it's really been it's been great to watch. And hopefully this time around we have a lot of lessons that we already have in the bag that we can leverage from to make sure that homeowners get treated appropriately during this crisis that just seems to keep getting worse by the day. I guess the one of the main topics today is to talk about the PLS market in particular, but also whether or not there are risks that who the investor of a loan could impact the way that a homeowner is treated. And at SFA, obviously, we represent issuers of agency MBS and Ginnie MBS. We represent issuers and investors in all sorts of ABS categories, credit card, auto, et cetera, and certainly PLS as well. And so that's something that is a key core part of our constituency. And so because of that, we've been worried about the possibility that there would be disparate impacts on consumers, or disparate outcomes for consumers, depending just sort of on who the investor of their mortgage was. That's not, I think we can all agree that that's not what any homeowner signs up for when they select select a lender, and it's certainly not something we should tolerate in our economy and our system. And this type of behavior is, of course, what led to the creation of the CFPB and the Bureau's work. And it's critical work, and thank God it's there now, so that we at least can form some baseline minimum standards that everybody has to live by. But we've been concerned about this, as you all have been, and we don't want to ever be in any sort of position to ever be forced to defend any bad practice. We wouldn't do that. But more importantly, we wanted to press the industry to make sure it was ahead of it. And so we, in late March, early April, started convening our PLS market working groups to try and get our arms around this. And so we did put out a survey a couple months ago. The results came back about a month ago, where we asked all of our PLS servicers, who are also agency servicers, our REITs, portfolio lenders, and PLS investors, to fill out a series of questions as it relates to the way they were going to look at COVID-related forbearance requests and COVID-related borrower challenges. And we aggregated those results, and we're kind of analyzing them now and going back to the market participants to make sure we have it all right. I think ideally we will put this out, but we also want to sort of track how this thing plays out. We're at approaching this critical 120-day mark, where there could be some forks in the road. And so we really we're trying to get through that and corral everybody to kind of be as aligned as possible as that day kind of approaches, and seems to be coming at us pretty quickly here. But we do want to have some public dialogue about these results. I would say that I don't think the results will surprise you. We were relatively pleased with the initial results of our survey. This crisis does continue to drag on, and so I think we're going to test the system a little bit more. But our participation in the survey was quite good. Participation in our working groups and our committees has been good. And so, we have a little bit of what I would call an initial read on how the market, the PLS mortgage residential market is set up to deal with this particular crisis. And so I guess it's easy to bucket the results in good news and bad news. So I'll do that. So in the good news front, our survey showed a couple things. Most of our PLS servicers also serve as GSE securities. So there weren't that many SFA member PLS servicers who didn't do that. And for the vast majority of those, GSE and Ginnie securities dominate their portfolio. And so the dominant presence in the room for a lot of these servicers is going to be the agency market. And on some level, even if they wanted to have vastly different approaches depending on the investor, I don't know that a lot of the servicers actually have that type of scale. And so we almost are going to benefit from some of the fact that I think everybody kind of said, look, we know we have documents and there are some differences and there's some flexibility there, but look, we're going to try and replicate the agency process as much as possible, because that's where most of our resources are going. That's the thing that we're going to set up, and the rest has to be plugins and add-ons, and we don't want to do that unless we absolutely have to. So we're starting from a foundation of, I think, leveraging the GSE infrastructure that's there, because most of the PLS servicers also do service those securities as well. And so I think that's a positive. No one, even in the PLS space, is requiring anything egregious like a lump sum payment or anything really bad like that after the ending of a forbearance period. Every single PLS servicer in our market is offering forbearance upon initial request, and initial forbearance for COVID requires no documentation or attestation. At least the SFA members who we've surveyed have said that. And all COVID cases, we're told, will be eligible for repayment plans or modifications once the initial periods end. So, you know, at that point, I think we go into the very familiar world of NPV models, and et cetera, where the value is maximized for the overall trust. And so hopefully, again, all rivers kind of converge similar to the agency space. So I think that there is some natural impetus and natural momentum to keep these things aligned, if for no other reason than the gorilla in the room is going to dominate the way things happen. And so that's something that we're pushing everybody to leverage, and they're telling us that they will as well. Of course, there were some bad news, I guess, in the survey, or some news that we have to at least be mindful of. There are differences in treatment at the 120-day mark. So, you know, that is where we start to see some slight changes in terms of how things go. It feels like the biggest difference is the requirement for an attestation on the homeowner's part at 120 days that they still do need it. There's nothing is agreed, you know, as comprehensive as like HAMP documentation. We're not talking about full documentation, hundreds of pages of documentation requirements, but there are some additional certification requirements that objectively just are in the PLS docs, and the investors don't seem to want to waive those. They want the servicer to call the homeowner and ask them to sign a form to make sure that it continues. So like I said, that 120-day mark is kind of a critical breaking point, and so we're going to be watching that pretty closely to try and help make sure that that doesn't turn into something more than just a difference in requesting additional documentation, that kind of stays cabined in there. And of course, you know, as a sort of cosmological constant in the background of this market, servicers, of course, do differ in their quality. And so there are going to be some homeowners who I think feel and do have different levels of treatment, levels of responsiveness, levels of information that they're provided. And that's one of the things that our market, I think, needs to grapple with all the time. I think that if I were a betting person, and this may be a bold statement, I think that to the extent that there are homeowner differences in how they're treated, or the type of responsiveness that they get, the type of information that they say is forthcoming or not, I think that if it's a spectrum and some of it is differences in servicer and some of it is differences in investor, I think differences in servicer is going to be a big part of it. Differences in investor will play a role, but it may be dwarfed by differences in servicer practices. And that just means that we all as a group need to continue to be working together. That may be a bold prediction, but that's something that I qualitatively, after a lot of the conversations we had with our members, think is worth watching. So that's kind of what our survey showed, and we're right at this point where we're going to need to be tracking this even more closely, and we will, and we want to make sure that we're working collaboratively with Urban and with you all. Please, of course, always reach out. Feel free to reach out to me. Elena has my contact information. At SFA, we're totally available to speak with you all, your organizations, to leverage resources however we can collectively to figure this thing out. So we've got a good policy team in place, and we also get a lot of volunteer time from our member companies and law firms and such. So please take advantage of us, and please reach out to us if we can help. I guess I'll just end, before I turn it over to Lori, there are a few sort of big picture things I want to flag, and worth just kind of, you know, putting out there for everybody's consideration to kind of kick around as you go forward on this. Well, I feel I'm not terribly stressed about the residential PLS market. I am concerned, but I think who the investor is may not be as big of a deal as just whether or not the servicers are doing a good job. I think that the CMBS market is going to struggle, and is struggling a little. I think they're working on finding their footing. There are some specialty servicers in that market that are scaling up rapidly. But the CMBS market feels like it has some shades of the residential MBS market circa 2008, 2009, in that it is the epicenter of this crisis. It is where the biggest hits are being made in a lot of ways. If you think about commercial malls and shopping centers and hotels, I mean, these were highly levered enterprises in many cases to begin with. They've been hit really, really hard. Those deal documents are very bespoke in nature, and I think that they didn't have the, the test run of the 2008, 2009 sort of episode to build out their systems and their infrastructure and technology to make sure that they could scale for an event like this. And so I think over the next 6 months, that's going to be the market that could be a source of anxiety for borrowers in that space. And so that's something we need to watch. The second big point that I want to make is that in the last year and a half, I've really come to appreciate even more at SFA than I did even before, that the DNA of the PLS market really is bespoke documentation in nature, and not scale and consistent across all operators just to achieve massive scale the way the agency market is. And really the way that all of us in Washington who wanted to have a vibrant PLS market have been trying to make happen. So there's been a lot of efforts to try and revitalize this PLS market, all of which have tried to bring conformity and uniformity and consistency to this market. It's a group of folks who don't really think that way. I mean, you have issuers who think that they can find an investor that allows them to have a 120-day stop advance, and an investor that's willing to buy that from a particular issuer because they trust the way they service the loans, and it's built on these types of relationships and different sort of tributaries that just separate it from the agency market. And so I do think as we look at it over the next 5 years, there's plenty of challenges ahead if we still want to have this scalable PLS market that functions in a uniform manner. It really is difficult, and really will it does run counter to the DNA of the market. This could be a 3-hour conversation, so I'll try and stop there, but that's something that I think is worth us continuing to keep in mind, because it's been a learning experience for me for sure on that. And then the final point I want to make about PLS is to launch this thing into the next round of conversation is that it was left out of TALF, and this was a market that was struggling already, and it was completely left out of TALF. And TALF is buying all the way down to the bottom tier investment grade and some corporate debt. Well, I'm sorry, TALF is not doing that, but some of the other 13-3 programs are. TALF is, of course, a AAA only program, but there are AAA jumbo PLS out there that are very high quality, that are not serving wealthy borrowers. You're talking about coastal cities where mortgages are just outside of the conforming loan limit. And I think it was a real mistake on the Fed's part to completely snuff PLS in the TALF program. I think that the Fed TALF team has done an outstanding job. They've been very communicative. The FAQs have been great. The responsiveness has been great. I just think this was a mistake that was made somewhere. And so there's a lot of challenges ahead for the PLS market, sort of writ large. But there's a lot of goodwill and a lot of commitment to try and get through this on the residential space. And as we go forward, like I said, please reach out to us and see us as a resource to try and help you guys in any way we can. I could talk for a lot longer, but I should stop because Lori Goodman's a lot smarter than me. So I'll stop there and hand it over to her.
Well, thank you very much, Michael, for the very, very thoughtful comments. What I'd like to do is provide a very brief intro to, and then introduce the distinguished group of panelists who are basically going to carry this conversation. The CARES Act allows borrowers with mortgages backed by the federal government to request payment forbearance for 6 months and extend for another 6 months with minimal backup documentation. The CARES Act doesn't directly specify how the forbearance is to be repaid. Both FHA and the government-sponsored enterprises Fannie Mae and Freddie Mac have adopted policies in which the options for paying back the forbearance amount depend on individual circumstances. If an increased payment is not feasible, the forborne amount can be added to the end of the life of the loan. And when forbearance ends, the borrower will make payments equal to what they were making before. If the borrower can't make the prior payment, they can generally receive a loan modification to reduce the payment. Mortgages backed by the federal government constitute about 70% of the total. The 30% of mortgages not covered by the CARES Act, however, lack uniform forbearance and repayment plans. These mortgages include both private label securities and loans held in bank portfolios, insurance, REIT, or other portfolios. And while most are receiving forbearance, generally on documentation similar to borrowers subject to the CARES Act, the duration of the forbearance period may not be as long And while the repayment options are similar, the qualification tests for each may be different. The question is, what do we do about all this? Well, we want all borrowers to receive equal treatment under similar circumstances. This is hard to do for both economic and legal reasons. The economic reason: if a borrower is paying back $100 of a loan 30 years from now with no interest, that $100 has a present value of $35 today. In a government or GSE loan, that cost is borne by the government, which is the decision maker in deciding to offer the benefit. So that makes sense. In a non-agency mortgage, however, that cost is borne by the investors. And unlike portfolio investors who bear the cost of their own decisions, private label investors oftentimes have no say. And then there's the legal reason for this. The contracts governing how these borrowers and private label securities are to be handled can vary from one security to another. Every private label security is governed by a pooling and servicing agreement, which dictates what forbearance and repayment plans can be offered to borrowers whose loans are in these pools. Often the pooling and servicing agreements are vague or silent when it comes to covering the current set of circumstances. The servicer is sometimes the one that interprets what could be offered. Other times, another party, usually the lowest tranche holder in post-crisis private label securities, may have this contractual right. Moreover, as most PLS investors are not investing their own money, they oftentimes have a fiduciary responsibility to their investors, who are pension plans and retirement accounts. In short, your retirement savings. They have a legal responsibility to make sure that their investors are not receiving less than is promised under the contracts. And the complications do not end there. In a securitization, there are various tranches with different claims on cash flows. If there's going to be an economic loss, the decision has to be made on how it will be divided among the tranches and how forbearance and repayment is to be handled for this purpose. While this is sometimes addressed in the pooling and servicing agreements, it sometimes isn't. And depending on the governing contracts, the responsibility for interpreting the pooling and servicing agreement could fall to the trustee, the master servicer, or the bond administrator. While this doesn't affect the borrower, it does affect different investors differently. So while the optimal solution from a policy point of view is to align the treatment of non-agency borrowers with that of agency borrowers, it isn't at all clear how that might work. With that as a background, let's kick off our distinguished panel. We have Chris Henteman, the Managing Partner and Chief Investment Officer at 400 Capital Management. Eric Kaplan, the Director at the Center for Financial Markets, the Housing Finance Policy Program at the Milken Institute. Eileen Lindblom, the Senior Vice President and Head of non-agency residential mortgage-backed securities at Flagstar Bank. Lisa Rice, the President and Chief Executive Officer of the National Fair Housing Alliance. And Jay Williams, the Senior Vice President of Servicing and Financial Operations at Ocwen Financial Corporation. We've got a fabulous group of panelists. We're so pleased to welcome them to this call. Thank you all so much for participating. Just one note, if we have any reporters viewing this event, we urge you to check quotes with the speakers before using the quote. Thank you very much. So with that, I'd like to actually open the panel and start with the first question, which is, what do you see as the state of play in the private label securities market? Lisa, what are you seeing from the borrower side?
Thank you, Lori. Thanks for inviting me to participate, and I'm really honored to be here with the other distinguished guests on this panel to talk about these really important issues. And so, you know, Lori, your question is very interesting because when we talk about these issues, we oftentimes don't include the consumer perspective, and at the end of the day, it's the consumer who's downstream that's being impacted by all of these policies that we're talking about. And unfortunately, in terms of how borrowers are being impacted, the answer is it depends. right? If you happen to be in that 70% of the borrowers who were covered by the CARES Act, you're getting one set of protections and supports by the government and by the system. And if you're in that 30% that isn't covered under the CARES Act, you're in a completely different bucket. And my concern is, Lori, that this is not a market-driven crisis. This is a national emergency. What's happening in terms of the economic crisis in our nation isn't the fault of a borrower who did not act circumspectly or judiciously. We're in a state of a national emergency. And while the whole country is in a state of national emergency, we're not acting like the whole market should be protected. Only a portion of the market is being entitled to a lot of the supports that we've talked about. From an equity standpoint, that's not fair, right? Because for huge swaths of the consuming market, they don't get to pick where they fall on the mortgage continuum. It's the consumer, the consumers who've been historically locked out of mainstream financial opportunities and underserved groups who have the least say or control over where they wind up in the mortgage continuum. And so a lot of the challenges that we're facing are structural, they're systemic, and it's part of those systemic and structural failures that are causing some of the disparities that we're beginning to see. So for example, while those who are covered by the CARES Act, sort of are getting an automatic 120-day forbearance, we are hearing stories of consumers who are getting month-to-month forbearances, and they're not getting that security of the initial 120 days. My concern is that the longer this crisis goes on, and it's looking like it's going to be extending, the longer the crisis drags on, the more we're going to be seeing larger differences in terms of what kinds of benefits and protections consumers are getting. And those who are in that 30% who are not covered by CARES, I'm afraid are going to be increasingly on the losing side. So it may be now that while entities have some cash and some capital that they can lean back on, that they're providing consistent services to the entire market. But let's be honest, we don't have just huge droves of cash just sitting around, and the more people get cash strapped, I think we're going to be seeing differences in terms of decisioning around what servicers are going to be able to do and what investors are willing to put up with. So it's one of the reasons why, and you saw Michael said in his analysis that he's already seeing differences at the 120-day mark. And I'm just afraid as this crisis drags on, we're going to see more and more differences earlier on in that time span.
Thank you very much. Chris, what are you saying from the investor side?
I mean, it's a, I guess it is a, I agree with Lisa's analogy that this is not an economic crisis. This is not an unwinding of speculation, which is a natural economic event in a course of a cycle. We've seen it, and that's rational in terms of the way the distribution of losses should work, and that's the way a lot of these capital structures are set up. We don't have that event. We have really a natural disaster, and that's a big difference in terms of what's happening here. And it's the fact that this is a natural disaster that makes it so complex, because the infrastructure of the private label market really wasn't set up to really handle this type of unique natural disaster. And so the private label market quite frankly, understands that. And so I think that everything that comes out of the CARES Act, everything that is in favor of working with borrowers are all the right intentions. I mean, it is well documented, it's proven, it's in our data that working to keep borrowers in their homes, and keeping them paying is the best way to a positive credit result, without a doubt. So that is, but the execution of that is really not consistent. And as I mentioned, the infrastructure of the private label market isn't really set up to deal with it universally. Michael's comments with regards to the GSEs, and Lori's, yours too, are spot on. Frankly, the GSEs have handled it really well. I mean, granted, they have basically the benefit of government sponsorship and a checkbook that can pay for the time value of some of these decisions to forbear and push payments off. And so it's a luxury that the GSE market has that the private label market doesn't. And the private label market is a closed system. So what is at the core of this debate is how does a private label market handle that? And I think, you know, as Michael had mentioned, and as you had mentioned, Lori, it's not uniform. And so, and again, I apologize for not starting off the bat by thanking you for basically putting this together, because this is the best that we've gotten in a long time to get a lot of smart people to talk about this issue. And by way of a brief introduction, we're a very significant and active mortgage credit investor, and we consider ourselves very innovative in terms of coming up with solutions and making those solutions investable. So we do think that there are solutions. It's getting all the right minds together and sort of weighing all the options. And so one of the inflection points is trying to come up with the best solution for the borrower, making it user-friendly within the servicing infrastructure and the capabilities of the servicing infrastructure, and coming up with a solution that will support and can continue to bring institutional capital to this market, because it's necessary. I'm sure I'm going to get in front of Eileen a little bit in this. I used to sit in a similar seat. It's necessary. I mean, for the velocity of capital, for the ability to continue to efficiently create loans and availability of liquidity for the mortgage market and for the residential property market. This is a very important part of the puzzle. It may not be the biggest like the GSE market, but it's an important piece of it. So you know, we remain engaged. I think the investors, you know, are the ones that are, you know, sort of the last stop on a lot of these issues. And so you know, we're very interested in the dialogue. We've been very active speaking to servicers, and obviously we're very excited to be a part of this and contribute to the dialogue.
Thank you very much. Jay, what is your point of view as a servicer?
That's a great question. So I want to start with thanking you, Lori, for having me on the panel. And I spoke with Lori, just to give you other guys a little bit of background, actually last week, and walked through some of the challenges that servicers are facing. And she offered me the opportunity to be on this panel, and I jumped at it, even though, you know, given the servicer point of view is not always the best view, but I wanted everyone to understand what we're going through as a servicer, because we're really caught in the middle of all of this, because there is some very specific guidance, and then there's some very vague guidance as to what we can and can't do as servicers. And I wanted to share where we were and what our thought process is, and I cannot disagree with what others are saying. We believe the same thing that pretty much everyone on this panel and in this call believes, and that is we want to do what's in the best interest of the borrower and the best interest of the owners of those securities, whether those securities are owned by the GSEs, the government, or backed by the government, or owned by individual securitizations. One of the challenges that we faced right off the bat when this happened is the vagueness of the guidance within our PSA documents. You know, we really have not had a lot of securitizations put together since 2006. I mean, it's been a very small number, and those documents were written 2006 and before we faced a lot of these crises, the mortgage crisis that happened at the beginning of, or the end of 07, in this latest one. and that's not covered in a PSA because no one anticipated it ever happening. So what we and other services in the market are trying to figure out, what is the best way to handle this? What is the best thing that we can do for borrowers? But we also recognize that there are limitations by the PSAs, and we do have an overriding factor that we have to do what is in the best interest of the trust as we're doing what is in the best interest of the borrower. So we have been put in a tough spot. We have had the GSE guidance that has come out, and that's very helpful. One of the things in a PSA agreement, in almost every PSA, states that you have to follow accepted servicing practices. Well, if 70% of your loans are following a certain practice, that kind of creates that industry standard, but it doesn't override the other information that was in the servicing agreements that we have to follow. So it is a tough position that servicers are in trying to help borrowers the best they can. And to be perfectly honest, the guidance came out very, very late from the GSEs. I mean, people were experiencing issues early in March. The CARES Act didn't come out until the 22nd, I believe, or 24th. And the GSE documentation didn't come out until over a month after that. So we're sitting here dealing with borrowers as a servicer, trying to help everyone as best we can with very little guidance from anywhere. And that's why I think you saw a lot of disjointed conversations with borrowers from the different servicers out there. You know, some that have been through, you know, Ocwen services a lot of the PLS market. So we have dealt with borrowers in need throughout the last decade. So we felt more comfortable, and what we offer today is very similar to what we offered borrowers from the very beginning, which we believe is the right thing, which is actually mirrors what the GSEs came out with later on. Not all servicers had the benefit that we've had over the last decade in working with distressed borrowers. So a lot of them had difficulties in determining what to actually do with the borrowers. And I'm sure we'll talk further as to what can be done about that and the standardization of that. But it has been very difficult for servicers to figure out exactly how we're going to do this, exactly what we're going to do with the borrowers up front with the forbearance piece, much less what we're going to do with them at the end of the forbearance and how we handle that. But I think most servicers at this point, because that first group is coming up to the end of some of the forbearance periods for the shorter ones, are mirroring the GSEs, as Michael mentioned. I mean, a lot of the servicers are saying, well, that seems to be the correct thing to do. It doesn't violate anything in the PSAs. So it seems to be the best for the borrower, it seems to be best for the investor, and that's where everyone is headed. But as things continue to get worse, assuming they do, I don't think anyone assumes they're going to get better tomorrow. As things continue to get worse, it's going to put a lot of strain on the servicers to be able to satisfy everyone, to do what is right for the borrower and also do what is right for the investor. So it's a very interesting time to be a servicer right now.
Well, thank you very much. With that, let's turn to Eileen Lindblom for the issuer point of view.
First, Lori, I want to join some of my colleagues here and thank you for adding me to the panel. I think it's an excellent discussion, one that I've been taking a survey amongst many of my colleagues in the industry, both in the servicing, issuing, investor side, over the last several months. From the issuer side, you know, to Chris's reference, we really need to focus on all the different aspects of what's happening from the securitization standpoint, and that goes to the borrower, the servicer, the investor, how we're handling things generally from a programmatic standpoint. You know, yes, the PLS documentation is not consistent, and it's something that not from the servicing aspect, but certainly many other aspects over the last couple of years, we've been talking about consistency in the market, and this particular point has never come up, but you know, guaranteed it will be on every panel in future virtual conferences. You know, I think the good thing is, having gone through the prior crisis, is at least I think generally speaking, the PLS servicing documents give you a little bit more leeway to work with the borrowers without as many critical restrictions on the servicing side. albeit it is still vague, but there's general caveats that I think a lot of the programs have where you can go to accepted servicing practices. And I think you don't necessarily have to go with the GSE process. There's also, for those who are servicing also for portfolio, to be able to service these loans in accordance in the same fashion that you would for your own portfolio. So from an investor perspective, I think that that makes sense as well, because it gives the kind of portfolio manager aspect, brings that into the servicing. And consistency. So again, this was never prescribed in the documents that we have. I think they're basically, we're always playing catch up. The documents are much better again than they were in the last crisis, but certainly everybody's trying to come up with some modifications on how things should look going forward. Playing the balance between the consumer and treating the consumer with all the due respect that is needed, but keeping in mind the investor side, I don't think it's that hard of a balance to make. I think you have to understand how that entire picture works in order for you to both service the customer properly and at least be able to be transparent to investors. If you can't give every credit that you can to the investor, at least understand how it impacts them and make your decisions accordingly and be able to be even more transparent in your documentation. So for example, you can treat the borrowers, as per the CARES Act, but then there might be a different method that you can recoup your servicing advances. You can keep in mind when you work through the different modifications, how those end up impacting the investor, and do you have to offer every menu on the CARES Act to the borrowers without negatively affecting them. So again, just from the issuer side, I think it's important to look at every aspect of the servicing, the consumer, the documentation, and how you can work through a situation like this.
Thank you very much. And Eric, I'm going to give you the last word on this question. Can you unpack some of the various elements of this discussion?
I will. Thanks, Laura. And to reiterate, very happy to be here, of course, and to join all these folks on the panel.
And thanks also for your help in getting it together as well.
My pleasure always, Laura. Thank you. What you and Elena and the Urban team are doing across the board has been great, and I appreciate being part of it. So I'm going to try and hit some nuts and bolts. I think each of the panelists raised some key questions, but I'm going to try and drill down what would I be saying if I were an issuer or risk manager or a lawyer advising an issuer, an investor, a servicer. Haven't practiced for more than 2 decades, but once you're bitten, it's like being a vampire, right? You're always a vampire. So first of all, aspirationally, back to what Lisa was saying, aspirationally, the need for relief is a borrower-centric need. Right, if you're affected by COVID, it doesn't matter if your loan is in a Fannie Freddie, Fannie Freddie pool, or if it's an FHA loan, if it's a non-agency loan. If you're impacted by COVID, you have a need, and in a perfect world, aspirationally, the relief that you get should not be dictated by who owns the loan. This is sort of an expansion of what we saw in the hurricanes. We were, a few years ago, there were hurricanes and there were mini forbearance periods, and we were talking about that then. So if we're next door neighbors and each of us go and get a similar loan and we're similarly situated, and you get 12 months and I only get 3 months, that's not really borrower centric, but that is the impact. One of the keys here, Lori alluded to it before in her opening, is though, when you have a federally backed mortgage loan, ultimately you're putting the balance sheet of the government at risk. It's the government telling the government, ultimately, even though there's servicers have to make advances, it's the government that's taking ultimately that risk. In the private market, it would be telling a private balance sheet, whether it's an investor who's holding that bond or has it in a fund, or if you have it in portfolio, you're telling a private balance sheet to take that risk. That's a very big difference in terms of the implications for loans that are covered by CARES and not. So to break this down, I want you to think about if I'm a bank and I originate a loan and keep it on balance sheet, nothing is stopping me from giving CARES Act forbearance. I could give 12 months. The decision is, am I willing to forego all those months of payments? If I am, I can give whatever. I can give more than 12 months. But if not, it's an economic decision, and different portfolio holders are in different financial situations. But one of the things that they have to weigh is a year or two down the road, if you're in front of a congressional inquiry, or you're having a conversation with consumer advocates and you don't give that kind of forbearance, you will have questions to answer. And that's just one of the franchise and reputational risk questions you have to weigh versus your economic ones. That's just a fact, right? When you're holding these in balance sheet. But in PLS, back to the part about the contracts, you must look at the contracts. And yes, you could be servicing under 1,000 different servicing agreements or pooling and servicing agreements, and there may be 1,000 different contractual frameworks that you have to adhere to. And so from that standpoint, you have to make a choice. So in looking at the contracts, and we wrote a paper on this, I wrote it with my two fellows, Mike Stegman and Ted Tozer, and it was about this. It was the provision of forbearance in PLS, to look at the key issues and how to go about first identifying the questions that you have to solve for and the implications of the answers. So in these contracts, they're either going to be explicit as to what you do in a forbearance or a loss mitigation situation that applies in this case. There may be a hard-coded loss mitigation waterfall, for example, or it may be silent, and it may be left to the servicer's discretion and how they interpret accepted servicing practices, to go back to what Jay and some others were saying as well. And so you have to distinguish what the four corners of the document say. Some pooling and servicing agreements now actually give power and control of loss mitigation options to a bondholder, typically the holder of the lowest tranche. Not all deals, but a number of them. And so if there's a party in PLS that has the discretionary power to set loss mitigation policies and direct the servicer, or has an approval or disapproval power over the servicer's loss recommendations, then they have to follow that as well. And I want to put something also into stark contrast here. You can be a servicer and have the best intentions and say, well, operationally, we're set up for the CARES Act. We want to do right by the borrower and give 12 months like as if we were servicing to CARES. If the documents require you to do otherwise, every month that goes by and the more borrowers that require forbearance, the number of dollars that are impacted grows. And if you are providing forbearance when you're not supposed to, or when the documents dictate otherwise, the dollar amounts that you're diverting from one bondholder to another, that grows. And so you may be doing right by the borrower and societally, but you're opening yourself up to a lawsuit, and then that depends on how big a dollar amount you've now diverted in contradiction to what the contracts require. So these are the things that we're thinking about in PLS, and it's an unfortunate reality, but those are the nuts and bolts. And I'll tie it up here. One of the things that we hope to see, or wanted to try and push with through our paper, was to get these panels like these and industry participants together to try and wrestle with these questions and put the questions and potential solutions and interpretations out in the open. So as an industry, we could not just solve for these internally within our own four walls and with our own counsel, but together in order to come up with best practices and bring relief to consumers, but also protect the industry and have it operate properly, so that we don't find ourselves in a situation where we haven't done right by the borrowers and we have a wave of lawsuits on the other side of the COVID crisis. So we stop there.
Great. Well, thank you very much. Thanks to all the panelists for just really great answers in terms of how you're seeing things from your perspective. I'd like to move on to the provision of forbearance, and we're running a little bit shorter on time than I'd like. So if you could keep your answers on this sort of short, but just a few general questions on this. Is it fair to require more documentation from PLS investors than from PLS borrowers than from borrowers in government loans? Do you explicitly offer the forbearance, or do you require the borrower to ask? And how do you account for it in the deal structure? So with that, Lisa, why don't you kick off? Why don't we have the borrower-centric view first, Lisa?
Sure, happy to. So in answer to who's sort of entitled to the forbearance, everybody's entitled. Again, we're in a national emergency, one that requires people to be safely and stably housed if they are going to come out of this health crisis. So making sure that people have housing, that everybody has housing stability, right, is paramount, because if I have some housing stability but my neighbor doesn't, ultimately I'm at risk and my family is at risk as well. So ensuring that everybody can have access to forbearance for the whole 12-month period that we've offered it in the CARES Act, I think is of paramount importance. And I'm going to actually make an immodest plug for a piece of legislation that many consumer protection and civil rights organizations have been working really, really hard on, and that's the HEROES Act. I won't pretend that the HEROES Act is perfect. I won't pretend that it's the panacea, but it does do a lot, because it guarantees a 12-month forbearance for 100% of the market. It brings more consistency and alignment to the market and ensures that everybody can have those benefits and protections. And it does not set up this scenario where consumers have to provide burdensome or respond to burdensome documentation requirements when they're trying to make it through the pandemic and they have many, many other challenges to deal with: homeschooling children, taking care of sick family members, trying to get to work when the public transportation is shut down, trying to deal with working from home when you're living in a Wi-Fi desert, right? So all these other variant challenges that are impacting consumers, particularly consumers who have been underserved and consumers who live in racially segregated and isolated communities, where there are many resource deprivation issues that challenge people's ability to survive the crisis. I mean, it's really paramount that we focus on housing stability. So the HEROES Act does that. It also not only makes sure that people can be safely housed and get their forbearance for 12 months, but there's a liquidity component, right? Because we recognize that servicers can't offer that 12-month forbearance if they're not liquid. And so the CARES Act does include a liquidity component to ensure that borrowers can be supported throughout this crisis.
Thank you. Chris, what in terms of the provision of forbearance, what's your views on this? Is it fair to require the same documentation for PLS? Is it fair to require more documentation for PLS borrowers? What's your view on some of these issues?
I think it's a challenging one to answer. I mean, I think with regards to the environment we're in, I think you have to give everybody basically a pass. I mean, nobody expected basically this event, and it's hard to say that anybody could have prepared for it personally. I mean, so the loss of jobs, whether it's temporary or permanent, has been extreme and unanticipated. The disruption to families, as Lisa mentioned. So I think the initial basically forbearances are fine, and they're appropriate. As you get to the end of these periods, and those are for debate, but the periods are getting longer and they're being more flexible. And as the economy is starting to get some momentum back, whether it's 6 or 12 months, 3, 6 or 12 months, then I think then it does require some standard of basically whether they need additional forbearance. And I wouldn't be here to say that nobody should. I think it just has to be measured. Can't do people, is it required? And of course it should be available for people if they still are in need. But I think that some level should be addressed. There will always be a little bit of a moral hazard issue in these types of circumstances, and I think it's a very similar analogy to PPP. You know, it's not perfect, but you're going to get people that will use the ability to access forbearance as also an insurance policy. And I don't blame people for doing that. That's very natural. It's a very, very challenging time. So people will go ahead and take advantage of it. And as you get longer and into the environment, I think people basically have to demonstrate that they still have a need, and the industry should try to find a way to accommodate that need, but it should be measured. But just like PPP, there were a number of people that took up the PPP proposals that certainly shouldn't have actually sort of tapped into those lines. And so I think that as these programs evolve, I think basically some standards for measuring, you know, who should qualify and who shouldn't, should become more measured as we move through the environment.
Thank you. Jay, your views?
Yeah, so I think I'm going to agree with Lisa and Chris in that I think people who need assistance should get assistance. I don't think there's any question about that. I think that most people would agree with that as well, and I would also say most servicers agree with that as well. And it's not really disjointed between the investor's best interest and the borrower's best interest in providing that forbearance, which is why most PSAs do address the forbearance issue. You know, your question is fair. Well, I guess it depends on how you define fair. One of the problems we have with PSAs versus the GSE guide is that the GSE guide literally changes every month. And unfortunately, when a PSA is written, it's now locked in stone because there is no one who go in and can change that. You can change new ones that are issued, but you can't really change the old one. So I have to agree with what Chris said, in that, you know, at some point, you do need to verify that the need is there. But I think it can be very loose in making that determination. I think that with need, we don't have to have a lot of information unless the deals actually require that information. But we would need something to go past that point, whatever that point might be. And that's where the difficulty comes in as a servicer is making that determination.
Thank you. Eileen?
I would agree with the other panelists. I do think that there, you know, in every situation where you try to do the right thing and make sure that you're giving the care and assistance to the borrowers that are needed, there's always the careful few that are going to try to, you know, use it for other purposes. So that being said, you know, I think too there should be a minimal requirement of evidence. I mean, if a borrower truly is in trouble, they've lost their job, I mean, whether it's a letter or, you know, a pink slip or what have you, I think that a minimal requirement on a go-forward basis is positive so that you know that you're working with the right population of borrowers. I think it's also important that, and it's one thing that's been done at Flagstar from a servicing standpoint, is when you get to the end of the forbearance period is to have the proper staff in place to be able to talk to the borrowers about what their needs are and what they can handle on a go-forward basis from a payment perspective, so that when they are modified or the modification or the forbearance period is extended, it's proper and appropriate for that borrower. We're trying to, you know, develop very specific programs on the PLS side that fit, you know, within the CARES Act, but, you know, keeping in mind the requirements of the documents, and, you know, as Eric said, we have to live by the documents as far as what we are doing, but, you know, that's what I would say.
Thank you. And finally, Eric?
So I'll try and keep it short. You know, the decision was made given the nature of the pandemic and how brutal an impact it's having. As Chris said, there, of course, is a moral hazard issue with respect to a few borrowers, but at the end of the day, I think it was known and seen that this is it just has a wide-ranging and deep impact like never before. And that was the decision to say, look, no documentation. And if you think about the modification process, getting all the documentations for a modification, as RESPA requires, really difficult. And the people who are most likely to not be able to comply, or for whom it would take months and months of time that's critical right now, are the more financially vulnerable, the ones who are or more open, probably have more of a need, and just don't have the financial savvy or sophistication to keep all the documents at hand. And so the decision was made, rightfully so, to protect against that and not require documentation. SFA put in a request to the IRS, and the IRS came through with a revenue procedure 10 days later. This was in April, to make sure that giving the type of forbearance of the type that the CARES Act requires in the government world was okay in a REMIC, and that a real estate mortgage investment conduit, which is the structure of most PLS, for those who aren't aware of that, they wanted to make sure that entities in these trusts could provide that kind of forbearance, and they wouldn't run afoul of the regulations that govern securitization. So that's the first prong. Second prong, also very important, is that a lot of several of the agencies, including the CFPB, have undertaken actions to also make that clear, that servicers don't need to comply with RESPA in terms of the Real Estate Settlement Procedures Act, by the way, one that covers servicing regulation, for those who don't know. But normally there are requirements that you have to collect documentation in order to engage in certain loss mitigation. So they relaxed that and made it clear that you could give this kind of forbearance in connection with the pandemic without collecting that documentation, for the very reason. So those were two very important steps. I'll say this last, I know we're going to talk about it. Collecting documentation, though, on the other side of this is going to be very important, because if you really need to know, and we have to focus on the sustainability of repayment, let alone whether or not a borrower needs the forbearance, you need to have an understanding of the borrower's financial position to make sure, even from a borrower-centric perspective, that you're not saddling them with a repayment option or method that they can't sustain. So I know we're going to get into that, but that also weighs in favor of collecting some backup documentation so you can actually do right by the borrower. So.
Thank you, and that's a perfect segue. We are going to turn to the repayment of forbearance. Generally, the repayment options are similar across private label securities and across government loans. You pay back the money as soon as you can, if you can afford an increased payment. If you can't afford an increased payment, but you can pay your prior payment, in that case, the money is added to the end. And if you can't afford even your current payment, you would be eligible for a loan modification under certain circumstances. So the repayment options are generally fairly similar, but the qualification for each may be different. So who decides in a private label security who gets what repayment option? How is it decided? What do you do with those that are unemployed or underemployed at the end of the forbearance period? And what are the implications for the deal? So with that, why don't we start with Chris?
I hope I don't have a really serious echo that I just heard, but I'll continue.
You sound good.
Okay, I'll drive through it. Yeah, that's at the heart of the matter. I mean, it's to the comments that you made at the beginning. I mean, there is a cost that comes with, how do you work all the way through the process? And so, in the PLS market, it's a closed system, and so you have the cost of capital that is really a cost for a natural disaster, not due to a credit issue, and so. It's not consistently addressed, and I think what you had mentioned, Lori, was effectively the payment path for CARES Act or GSE related loans, and from the discussions we've had with different servicers, we get different feedback in terms of the way they are addressing private label loans, and that's one of our biggest concerns, and that's one of the shortcomings of the private label market. Is that there is not a standardization across servicers with regards to how they plan to handle the repayment of these plans over time. And so, and as you had mentioned that, in the extreme case, you defer to the end of the loan an amount that should be due and can be constructively recast in the P&I payments in constructive ways that we've seen in the past, and there are precedents for them. But if it's not done creatively and with some effort and by all parties, it can be very expensive. As your example pointed out, $100 can turn into $35 to an investor, and that's a cost that wasn't intended in terms of the way these structures were set up. And so one of our biggest concerns, and I think it should probably be shared amongst everybody here, is that actually can erode the integrity of the market if it's not addressed. And I think one of the things that we think a forum like this and things that we're doing outside of this is actually trying to work with partners in the market to come up with ways that the market can adapt to address constructively with certain precedents that are in the market, to work with borrowers to come up with payment plans that are constructive for both the borrower in terms of resetting the payments due in form of new P&I payments, or as you had mentioned, modifying the interest rate, modifying the term of the loan, but doing things that actually work with both the borrower and the investor first at the top of the waterfall before basically just deferring the payments to the end and creating an incremental cost.
Thank you. Jay?
Yeah, so there are options. Now I have the echo. Are we good?
You sound fine too.
Oh, okay. The repayment options are not. There's only so many that there are. There's a limitation on those, simply because of math, right? And Chris was absolutely correct. You can have the borrower pay it all up front, which most of the borrowers are not going to be able to pay it all up front. They don't have the cash sitting around to make up all those payments once they reach the end of forbearance. There are repayment plans, and those repayment plans can be structured differently. That's one of the advantages of the PLS world having less restrictions than the GSEs, in that we can structure repayment plans in various different ways to accomplish both helping the borrower and maximizing return for the investor. And then, of course, you do have the other options, such as the deferral and such as the modifications. That obviously, that last one would be just a form of a modification that recast. Now, I will say that when in doing modifications, different than the deferral, you do require that documentation. So you are going to have to go down that documentation path. And as we mentioned, sometimes that's kind of difficult for these particular borrowers to provide. At least right now, hopefully that turns around and it doesn't become that difficult. But the answer is, who decides that? Well, ultimately, it's going to be the borrower. Because we can put the greatest plan in the world in front of them, but if the borrower doesn't want to do it, we can't force them to do it. So ultimately, it's going to be what works for the borrower, or at least what the borrower believes works for them within the confines of the PSAs and what they allow us to do. But ultimately, we want to be able to have a payment that the borrower can afford going forward, the sustainability, and whether that payment is a little bit more by doing like a repayment type thing, where the payment's exactly the same, or whether that payment's a little bit lower by doing a full modification where you perhaps lower the rate or some other lever that you can pull to get that payment down if this permanently impacted earnings going forward. So, like I said, ultimately it's up to them. As far as the employed, underemployed, that's where the modifications come in. If their income is cut by 70%, I'm sorry, by 30%, so they only have 70% of the income, obviously it's going to be very difficult for them to continue to make a payment they had pre-COVID. Again, not their fault. I'm sure they're not the ones that created COVID, but it is impacting them. And it did impact their income, so you would have to move into some type of modification to get their payment down a little bit. So that's kind of where we are right now with the options that are out there. We do have more flexibility in the PLS world, but there are some restrictions as well. I mean, some There are some caps and restrictions within PSA. Some don't allow modifications at all, so you have to work out some other form. Some require investor approval, and although we can tell the investor that this is the best option, that doesn't mean that they will always agree with it and could deny that. So there are some restrictions, but in a lot of the cases, there's some more flexibility we have over the GSEs.
Thank you. Eileen?
My answer is really, it's going to boil down to the combination of the servicer and the borrower. From the issuer standpoint, I think the most important role that we play is to ensure that we know what's going on from a servicer standpoint, what options are being provided, understanding how they're impacting the cash flow of the transaction, and understanding how they impact, therefore, the investors. So really, again, kind of the middle party, I think we can educate the servicers with the different options and how they end up affecting the cash flow and end up affecting the end investor. And I think that's a critical role that we need to take and be advocates for the consistency in the market as far as how things are handled.
Thanks. Eric?
So on this one, I've been clear all along. I've gone on record. The focus has to be on sustainability. If we don't provide an option, a repayment option, or some loss mitigation option on the other side of the COVID pandemic after the forbearance period to a borrower who is able to sustain an option, then all you've done is, why give the forbearance in the first place? You've just taken them out of the frying pan just to put them back in the frying pan. But if there's an option that is sustainable within the bounds of what's allowed, if it's in PLS or certainly a balance sheet, then we must do that, because I think that's what's required. So it all has to be on sustainability. As Jay was saying before, the more flexibility you have to come up with a sustainable option, the better. The GSEs, for example, through FHFA have taken some steps on that, where if they didn't allow deferrals. Now they allow deferrals. They only allowed 6-month repayment plans. Now they can extend it out much longer than that. So those are all key moves. I've tried to raise this with the CFPB as well, and they are really aware and focused on this as well. But that's a critical thing. The other part is in terms of who decides. I have a concern there. I know firsthand that, and this is anecdotal through people who have come to me with it, but in the beginning of the forbearance period, I have friends in non-agency, loans were on a balance sheet, and they were offered 3 months and a mandatory lump sum repayment right afterwards. I'm hoping that no servicers are doing that now. I think if a person has been in a forbearance period because they became unemployed or suffered a severe curtailment of income, to expect them to make a lump sum repayment on the other side of the pandemic or after the forbearance period is ludicrous. And so I would like to see mandatory lump sum repayments just completely banned for all channels. It just doesn't make sense. Give them 3-6 months, even if they can do it. But the other key part is who really does make that determination. Because in many servicing scripts, you see it says, if the borrower cannot afford a repayment plan. Well, who's to make that determination? Yes, it would be great if the servicer and borrower or the investor, because remember, servicers, I think, are getting a bad rap where they're not the ones who are making the decisions. And that's very important to point out, especially to folks in DC. But it's really important to know in whose discretion that decision lies, because if it is the borrower, that's one thing. But if it's a servicer or an investor that's making a determination based on a formula might work for some, may not work for others. And again, the worst thing we can do is to have a person get through the forbearance period, have them back to a point where they can sustain a repayment plan, but deny them that repayment plan because the party making the decision's evaluation is different than the reality of the borrower. So sustainability is going to be key there in order to reduce the pain, not only to borrowers, but also to holders of loans or investors and servicers as well.
Lisa, anything to add?
Nothing to add.
Okay, so we are very short on time. So what I'm going to do is ask the last 2 questions to the panelists together and answer either one or both, but keep your answers short. So first, what can we do to encourage more standardization near term and longer term? And second, if you were emperor of the market for a day and the market actually listened to you, what would you do? And how would you handle the various trade-offs inherent in this? So I'm going to actually, we're going to use the following order: Eric, Lisa, Jay, Eileen, and then I'll give Chris the last word. So Eric, why don't you kick
Thanks. So
that off?
standardization in this case, I think, would be where there's similar contractual language, get parties in a room. Right now we have deals where you have 2 servicers or 3 servicers in a deal who are interpreting the same language differently. And it completely obliterates the integrity of the data that's going to the master servicer. That doesn't do anyone any good. And if I'm an investor, if I'm in Chris's position, I'm going to be watching that very closely. So standardization around the interpretation of language that's similar in deals, because there are similarities in language within buckets of deals. If I were emperor, I'm going to point to RMBS 3.0 and say we talked about some things that could be done, and 2 things come to mind. One, bondholder communication platforms. Because if there are certain, whether it's amendments to transactions to allow for more effective relief, where the documents are hard-coded and constrain what is able to be done in the deal, an effective bondholder communication platform would be incredible here, because you could get the response of investors more quickly and give them the information that they need to know in order to approve, amendments that would help in this situation. The second thing is, if you had a deal agent, if you had one party that was acting on behalf of the trust, was empowered to act on behalf of investors, and loss mitigation fell to them, you would get a much more trust-centric and therefore, I think, more effective borrower-centric and consistent approach, rather than the differences that cut across PLS right now based on who's making the decision, or how clean or clear or obtuse the language is in the documents. So that's my thoughts.
Thank you. Lisa?
Sure. So in terms of standardization, the thing that strikes me is that the infrastructure that we built to increase standardization in the marketplace in the aftermath of the Great Recession has really dissolved, right? The Hope Loan Portal and Hope Now and all of that. And one of the things I think we need to do is just recognize that crises like this, national disasters, are here with us to stay, and we need to act like it and be prepared for it. So we need to develop an infrastructure so that we can handle these kinds of national and regional crises as they happen, and we're not stuck every time a crisis happens trying to build the wheel again so that we can provide servicers with support and support the market. If I were emperor for a day, I would pass an equity-based stimulus, I would pass the HEROES Act, and I would fix servicing so that there's alignment across all sectors.
Thank you. Jay?
Yeah, so I think standardization across the PSAs would be an excellent thing, and I think because the language is vague in a lot of deals, I agree that one of the things we could do is come to agreement on what the language means, and not just deals definitely where you have more than one servicer in one deal, but even across deals that are very, very similar in language. Having the same interpretation of those, that would go a long way into solving a lot of the issues that we have right now, where servicers are making the determination based off of what they think it says because of the vagueness of the language versus what another servicer perceives that to be. That to me is going to be the easiest thing to do in the short term. It's going to be the most beneficial for solving both the issue with the borrower and basically having transparency with the investor to know what's going on, how this is going to be handled, and so forth. And I would say, if I could change anything, is I would give more power to the trust to be able to alter when new things come about. Again, like I said before, it's easy with the GSEs because they can go in and change their guide at any moment. But these PSAs that were written in 2006 and before, there is no changing them easily. Obviously, you can get the bondholders to approve it, but that's almost impossible to get them to agree on anything. And because the people who own different tranches have different perspectives on what they think is right in a lot of cases. But that's kind of what I would do if I had that ability.
Thank you. Eileen?
I try to talk really fast. I think really it's consistency and clarity in the documents from a servicing standpoint. You know, we've talked about so many different angles of consistency, whether it's due diligence or reps and warrants, et cetera, over the last couple of years. This is key, and it's live, and we have to address it and give the servicers clarity, no gray areas as far as interpreting what they should and shouldn't do, and then bringing greater transparency to the investors. Emperor for a day, I'd have a cure for coronavirus and peace in the world.
Thank you. And finally, Chris.
She steals the really good soundbite there. I mean, I do think that like this, all these events sort of highlight some of the weaknesses in these markets, and so they just offer us an opportunity to improve the market. So I do think I agree with sort of everybody's general comments that standardization needs to be addressed in the private label market, and we still see that it's obviously there's a lot of idiosyncrasies, and they come to light in these environments, and so you know, whether it's a for like it's a self-regulated organization amongst ourselves, issuers in the PLS market, issuers and servicers and investors that could talk through what are the best practices and establish a list of best practices that may start to define the haves and have-nots of who operates in this market would be basically my way of volunteering a solution towards standardization. You know, it's going to take some leadership, that's focused on this sector. Michael brought up some great points, and Michael's organization does some great things. It does get distracted with, as he mentioned, CMBS and other consumer-related issues, which are equally as complex. But this market has specific issues that it needs to address as well, and the servicing industry is really a complicated area. One of the things, if I was emperor for the day, and I'll throw a little bit of a crazy one out there, and I think Michael touched upon it a little bit with regards to his comment around TALF, is I would try to establish a federal program that actually provided for a facility that subsidizes advances for servicers that is not addressed in the private label market, but is addressed in the GSE market. And that's where us as an investor, we have the biggest anxiety, is that starts to basically become a cost borne by basically investors. And that's what we're trying to avoid. And so that's the challenge that this market has right now is because we're in the private market, the facility hasn't been addressed. It's complicated to do, and that would be my goal if I was emperor for a day. If I could get it done in a day.
We wouldn't require that.
Which in Washington might be very hard to do.
We've gotten I'd like to thank all the panelists for just a wonderful discussion. We've gotten like a bunch of questions, and I'm going to actually ask two of them. The first comes from Kara Ward. What is the appetite or ability of non-federal investors, owners to work towards standardization on repayment terms and deferral? And so why don't we, Chris, why don't you take that one? And then the second question is going to deal with housing counseling, and I'm going to ask Jay and Eileen to take that one. And
I'll try to keep it simple. I mean, the willingness is super high. I mean, we're really motivated. We're an active investor in the space. We like the space. We see the utility it has to the real estate markets. We're always going to be in this market. So our willingness to basically try to address it is really high. I think members of this call actually know that we've reached out. We try to offer what we think are very constructive solutions. We sort of pride ourselves on being innovative and trying to create a balance. So there's a willingness. The ability is really tough because it's a fragmented market. People have different processes, and maybe Jay can comment on this. There's different capacity to change the infrastructure. As much as even a servicer might want to do it, your operations may be much more geared and scalable towards GSE solutions than private label solutions. And so we have to deal with those idiosyncrasies in this market and just unfortunately, it's a fact of life, and that's one of the big challenges is just the operating capacity to handle some of these suggestions.
Thank you. Eric, do you have anything you want to add to that, actually?
No, I mean, in the interest of time, I'll actually hold back. But I mean, at the end of the day, I do think going back to the part about it is in the benefit of investors, issuers, to the extent they're on the hook for anything under the documentation, just to come together and to try and have some more consistency and clarity, avoid potential lawsuits, put more certainty and clarity up front. So you know what the expectations are. You can make an informed decision. There's rules of the road that you can abide by that make sense and are thought about up front or signed off on by all. So, I mean, just as a general proposition, I think it is in everyone's interest, but currently there are differences, and those differences have to be acknowledged because those are effectively laws of physics in the deal right now, or in the different deals.
Thank you. And then we've gotten a bunch of questions on Sheila Hawthorne asked, what is the role of housing counseling in this? How are servicers incorporating housing counseling agencies to help? And then Tracy Peterson, and then Ellie Pepper asked, sometimes as a housing counselor, we're given the runaround, repeated requests for the same documentation. Is there best practices to resolve this? And there was also a question from Tracy Peterson. How do I get the PSAs? I'm a housing counselor, and it's possible to obtain the PSA by going through the SEC, but you can only do it if you have the correct name of the trust. Can you get cooperation from the servicer to provide the PSA upon request when we're working with the borrower? And that way we can help. So why don't we take those questions in any order? I guess, Jay, Eileen, do one of you want to start?
So I can start with the PSAs. Yep, they are public documents, and yeah, we can provide the name of the actual trust. I'm not sure if we can provide documents to everyone, but as far as the housing counselors go, we may be unique as a servicer, but that's something that's always been very important to us. I actually have we have a biannual, semi-annual meeting, Consumer Advisory Council meeting that has a good number of the housing counselors, among others, on it. We think it's very important to involve the housing counselors in anything we do. We have historically provided outreach events with the housing counselors. We are still doing it today. It's similar to what we're doing right now. It's something that it's through Zoom, but nonetheless, we're still having it today to try to have outreach to borrowers, and we've been very effective on that. I know not every servicer does that, so I may not be qualified to answer for every servicer, but we definitely think the housing counselors play a very vital role, not just today, but historically, and for days to come. We believe they play a vital role, and we involve them every step of the way. I'm not going to sit and pretend it all goes perfectly, but we think we have a very good relationship with the housing counselors out there.
Eileen or Lisa, do you want to add anything to that?
Yeah, sure. I am not at that level of expertise as far as what's happening on the servicing side with housing counselor. I know that Flagstar is a Fannie Mae Star servicer. I'm sure that we're taking advantage and every opportunity to assist the consumers. The one thing that we've done in this situation, which I'm not sure how common this is across the board, I mentioned it earlier, is Flagstar put together a dedicated team to have single point of contact to borrowers who are coming off the forbearance plan, so that they have don't get the runaround and kind of deal with all the issues that happened in the last crisis. So I think that is something that is important, that the borrower has somebody to work with, a dedicated person, so they can get all the documentation through as expeditiously as possible.
Yeah, the only thing that I'll add is, and this is just a build off of what I commented on before, that during the last crisis, the Great Recession, we did build this great infrastructure to really help consumers connect with their servicers so that we could more streamline the process and standardize the process for providing documentation, helping consumers understand what benefits they could access, helping consumers understand even things like who their servicer was, because that can be very difficult sometimes in the PLS market. So we let that infrastructure go fallow once the crisis had really subsided. And now we're back, we find ourselves in this scenario where we really do need that support again. So the Hope Loan portal system worked perfectly because the consumers provided their documents through the portal, and then the servicers could access them. So you didn't get this repeat asking for documents over and over again because they were already housed on the portal. And the housing counselors also play a role because they're located in local communities. It's easy for consumers to access fair housing and housing counseling organizations. And it may be more difficult for consumers to be able to pass documents or transfer documents from their home, particularly if you have consumers who don't have access to Wi-Fi service and things of that nature. So I just will add another plug for ensuring that we keep the counseling pipeline open, we keep that infrastructure built up, because we're going to continue to have these crises over and over again.
Well, thank you very much. Thanks to our fabulous panel of speakers, Chris Henteman, Eric Kaplan, Eileen Lindblom, Lisa Rice, and Jay Williams. You guys were just incredible. The next Housing Finance Policy event is going to be on August 6th at 3:30. It's on how changes in property taxes shape communities. It's 2 case studies. We'd love to have you tune in for that. And with that, it's a wrap. Thanks so much for tuning in today. This was just a fabulously interesting discussion. And again, thanks to the wonderful panelists. And thanks to Michael Bright for kicking us off.
Thank you.
Take care, everyone.
Appreciate it.
Thank you
Lori.
so much.
Thanks.
Bye-bye.
Thanks, everyone.
Bye.